Welcome to a new episode of Inside the Economist's Mind. Today we're doing a deep dive into the latest economic insights, drawing from a key weekly report that covers Australia, New Zealand, and the wider global picture.
Yeah, that's right. Our aim here is really to unpack all this analysis,
Yeah.
the reports, the forecasts, what the central banks are saying, and pull out the key takeaways.
Make sense of it all.
Exactly. What are the important shifts? What does it actually mean for, understanding where the economy is right now and maybe where it's heading next for you?
Okay. And this week's report, it's definitely packed. We've got some pretty significant central bank moves, especially down in Australia. Some interesting changes in economic forecasts, too, and a whole slate of data coming up that we really need to keep an eye on across different regions.
Absolutely. Lots to cover.
So let's jump straight into Australia then, because the big news there was the Reserve Bank, the RBA, making that move. They cut the cash rate. Can you unpack the significance of this? It was 25 basis points, right? Taking the rate to 3.85%.
That's it, 3.85%. Look, the cut itself wasn't a huge surprise. It was pretty widely expected. But what was significant, and the report really flags this, is the RBA's tone.
How so?
Well, they described the new rate as somewhat less restrictive, which is standard enough. But the overall communication, particularly from Governor Bullock, it just felt distinctly more dovish, more inclined towards easing than we've heard for a while.
Right, and they use that phrase confident cut. I thought that was interesting. Confidence isn't exactly overflowing from central banks globally right now. What gave them that confidence?
Yeah, that confident cut language really stood out. The report suggests it stems mainly from their inflation outlook. They now expect underlying inflation to be basically around the middle of their 2–3% target band for, well, quite a long time, most of the forecast period actually, out to mid-2027.
So they see inflation coming down nicely.
Pretty much tracking expectations, both theirs and Westpac's. And that downward path seems to be the main driver for the shift in tone. Governor Bullock even said the recent inflation moves were encouraging.
Okay. The report also mentioned a change in how the RBA sees offshore risks and trade developments. How did that factor in?
This was quite a pivot, actually. The RBA is now explicitly saying these global trade developments, even with all this sort of roller coaster tensions, are actually disinflationary for Australia.
Which is different from before.
Yeah, previously they were more, it could go either way, push inflation up or down. Now they seem less worried about major supply chain disruptions pushing prices up, especially after that recent U.S.-China sort of interim deal.
Okay.
And they also share the view, which the report notes, that China seems pretty determined to hit its 5% growth target, which adds a bit of stability to the global outlook they're looking at.
So the global picture looked a bit better, or at least less risky.
Yeah.
But the report suggested the domestic inflation story was strong enough on its own for the cut.
That's exactly the read. The trends in domestic inflation were sufficient justification. The improved global backdrop just sort of reinforced it. And it's telling. The report mentioned that during the media conference, the idea of not cutting, of holding rates, was apparently discussed but quickly dismissed.
Ah, okay. So strong consensus then.
Seems like it, yeah.
So the rate's now 3.85%. The report notes that's not considered miles away from neutral, that sort of theoretical Goldilocks level for rates. Where does the report see things going next? Is this it for cuts?
Well, Westpac's base case, which the report generally aligns with, is for 2 more cuts this year.
2 more?
Yeah, penciled in for August and November. That would take the cash rate down to 3.35% by year-end.
Okay.
But, that's conditional. It depends on inflation continuing to behave as expected and no major global shocks throwing things off course.
And the risks.
Importantly, the report flags the risks to that forecast are biased to the downside. So potentially more cuts if things weaken rather than fewer.
Understood. Now, the labor market, always crucial for central banks. How's the RBA seeing tightness there, according to the report?
They still acknowledge there are signs of tightness remaining. But interestingly, their updated forecasts nudged up the expected unemployment rate path slightly.
Okay.
And they trimmed their forecasts for growth in employment and wages just a touch. And this leads into, I think, one of the really fascinating bits in the report, their discussion around the NIRU.
The NIRU, the non-accelerating inflation rate of unemployment, that theoretical level below which inflation supposedly takes off. What did the source say about the RBA's thinking here?
This was genuinely revealing. The report references Freedom of Information releases showing the RBA's internal models back in March were estimating an ARU of 4.69%.
4.69%, that sounds high.
It is noticeably higher than what most market economists estimate. They tend to cluster around, say, 4.25%.
Right.
And the RBA themselves, according to the governor's comments reported, basically acknowledged they might be overestimating it. Or, put another way, underestimating how low unemployment can actually go before inflation becomes a problem.
That's quite an admission.
It is. And that uncertainty, that acknowledgement they might have this key input wrong, was part of why they applied some downward judgment to their inflation and wage forecasts.
So they manually adjusted the model outputs down.
In effect, yes. The report mentions they even explored a sort of straw man alternative using a 4% ARU in some internal analysis. The governor also stressed looking at broader metrics, not just the model. But the core point is, their outlook relies heavily on this number they admit might be off.
That really helps explain the confident cut then. If they suspect their models were maybe a bit too hawkish on the labor market side, it gives them more breathing room.
Exactly. It kind of recalibrates their position, maybe away from what some saw as a bit of an outlier view on just how tight things really were domestically.
Okay, another thing that caught my eye was the forecast change for household consumption. That looked like a pretty big downgrade.
Yeah, that was significant. They cut their forecast for household consumption growth quite sharply, from 2.6%, which was looking pretty optimistic, down to 1.9%.
Which is closer to what others are thinking.
Much closer to the consensus, yeah. Governor Bullock basically said consumption hadn't picked up as they'd hoped, and that households are being a little bit cautious. And the report notes that lines up pretty well with Westpac's own data, things like their card tracker, showing that consumer caution.
Okay. And just quickly, the report mentions something about a new system for implementing monetary policies starting this month.
Correct, yeah. More of a technical, procedural change in how they operate day-to-day and structure their announcements rather than a policy shift itself, but worth noting if you follow their releases closely.
Got it. Okay, let's hop across the Tasman to New Zealand. They just had their budget 2025 tabled. What was the report's take on that from a macro perspective?
Well, the report described it as, largely lacking big surprises compared to what had been signaled earlier. No major bombshells at the macro level. But while the starting point was a bit better, the path ahead for the operating balance that's the government's sort of day-to-day budget surplus or deficit, it looks less favorable over the next few years.
Meaning bigger deficits.
Accumulated deficits are forecast to be about $7 billion larger than they thought previously, yeah.
And bigger deficits usually mean more borrowing. How did that play out in terms of bond issuance plans?
Exactly right. They need to borrow more. The government lifted its bond issuance forecast by $4 billion over the next 4 years. That was actually in line with Westpac's own expectations.
Okay.
Interestingly, that extra borrowing is quite backloaded less in the next couple of years than previously planned. So the peak for net core crown debt, their main measure, is now projected at 46.0% of GDP in 2027-28.
Still heading higher then?
Yeah. The report suggests getting back into their long-term target range of 20-40% looks pretty unlikely this decade.
Were there any specific policies the report highlighted?
The main fiscal juice came from an accelerated depreciation policy for businesses. They're calling it the investment boost. That's set to cost about $6.7 billion over 4 years, hoping to get firms to invest sooner. They offset some of that by trimming new spending allowances this year and finding savings through changes to pay equity laws and reducing government contributions to KiwiSaver.
KiwiSaver, the retirement savings scheme.
That's the one.
How did the bond market take all this? And did the report flag any remaining risks?
The local bond market actually reacted reasonably well. Mostly relief, I think, that the borrowing increase wasn't even larger, which has kind of been the pattern recently.
Right.
But the report does caution that the risks to the bond program probably still skew towards more issuance, not less.
Why is that?
Things like the government's general appetite for spending, potential pressures for more capital spending on things like defense, and, the simple uncertainty around a possible change of government after the election next year.
Okay, so how does all this budget stuff feed into the thinking over at the Reserve Bank of New Zealand, the RBNZ?
The report's view is actually not much impact. Relatively limited implications for the RBNZ's path.
Really? Even with the spending changes?
Well, the Treasury did estimate a slight disinflationary impact from the package overall, but the core view in the report is it doesn't fundamentally change the immediate outlook for the RBNZ.
Interesting.
Though they do note the KiwiSaver changes might dampen spending a tiny bit for those individuals who decide to up their own contributions to compensate.
Okay, and speaking of the RBNZ, their policy decision is the big event for New Zealand this week, right? What's the expectation there?
Yeah, absolutely key event. The consensus forecast, and Westpac shares this view, is for a 25 basis point cut to the official cash rate, the OCR.
Taking it down to 3.25%.
That's the expectation, 3.25%.
And what about signals for the future? What kind of forward guidance are we likely to hear?
They're expected to stick with a data-dependent easing bias, basically saying, we'll cut more if the data warrants it.
Makes sense.
The RBNZ's own forecast track for the OCR will likely be revised down, maybe by around 20 basis points or so, suggesting rates could get to around 2.9% by the end of 2025.
And the timing of the next potential cut.
The way they phrase the outlook for the third quarter is expected to keep the door open for another cut, maybe in July or August. Gives them time to see the next round of inflation and activity data.
What about other options? Holding steady or a bigger cut?
The report assigns pretty low odds to either of those holding unchanged or going for a bigger 50 basis point cut. 25 points seems the most likely.
It sounds like the RBNZ is juggling a few competing pressures.
That's definitely the narrative in the report. They're caught between, on the one hand, uncomfortably high short-term inflation, prices are still rising too fast right now, and on the other hand, growing downside risks to growth and inflation further out.
Tricky balancing act.
Very. The summary record of their meeting is expected to show a potentially vigorous debate among the committee members. Weighing the risks of cutting too soon versus waiting too long and maybe causing a sharper slowdown. The report speculates some members might push for a more cautious pace of easing.
Did the report mention any alternative scenarios the RBNZ might be gaming out?
Yes, it anticipates they might present an alternative scenario involving, say, renewed global trade tariffs, and escalation maybe not quite as severe as the RBA's assumed scenario, but still disruptive.
And what would that mean?
That scenario would likely involve weaker investment, slower consumption, higher unemployment, prolonged uncertainty, basically. And the implication, though they might not put an explicit number on it, is that the OCR could need to go lower in that situation, perhaps towards that 2 to 2.5% range.
Okay. And just quickly, other NZ data points this week.
We get the monthly employment indicator, ANZ business confidence, and building permits are expected to drop back a bit after a recent spike related to some large housing projects.
Right. Okay. Let's zoom back out to the global picture. We heard how trade tensions influence the RBA. What else is the report saying about the international backdrop?
Well, as we touched on with the RBA, the report reiterates that view that Chinese authorities seem pretty determined, a high appetite, they call it, to hit that 5% growth target this year.
So no hard landing expected there.
The expectation is for growth to slow only modestly. Westpac pencils in 4.8%. The recent data out of China has been a bit mixed, though. Retail sales and investment were a touch soft, but industrial production held up quite well, especially in sectors like EVs and semiconductors.
And policy support continues.
Yeah, they've continued with some support. Recent cuts to lending rates, the LPR, and bank reserve requirements, the RRR.
Were there any other inflation surprises globally mentioned?
Yes, the April inflation data showed core inflation ticking back up again in both the UK and Canada, which was a bit of a surprise, especially in Canada.
How are their central banks reacting?
The report suggests they might diverge slightly. The Bank of England, perhaps facing tighter fiscal constraints, might lean towards worrying more about growth risks. Whereas the Bank of Canada, maybe with a bit more fiscal room and policy still relatively accommodative, is expected to stay more focused on inflation risks. They've explicitly said, policy can't stop price rises from trade shocks, but it must stop them becoming embedded.
Got it. The report also dipped into U.S. politics briefly.
Yeah, just noting President Trump's tax bill passed the House, but faces a much tougher path in the Senate, and also flagging the looming U.S. debt ceiling deadline, probably August or September time.
And the potential economic impact.
The report suggests the political focus needed for the tax bill and the debt ceiling fight might distract from other expected initiatives, especially deregulation, which markets had anticipated. So a failure to deliver on deregulation is seen as a potential risk to medium-term U.S. growth. We're just relaying the source's perspective here on the potential economic links, of course.
Understood. Okay, so looking ahead, it's a busy week for data releases. What are the key things listeners should be watching out for based on the report?
Definitely a packed week. In Australia, the big one is the monthly CPI indicator. Westpac's forecasting a drop to 1.9% year-on-year. Market might be a bit higher.
Okay.
We also get construction work done, private CapEx plans, where the focus will be on spending intentions for 2025-26, which might be soft for dwelling approvals, likely still soft, and retail trade. Westpac sees only a tiny 0.1% rise there, noting recent holiday volatility.
And New Zealand. besides the RBNZ decision?
As mentioned, the monthly employment indicator and building permits, with permits likely falling back after that lumpy rise last month.
Right. What about elsewhere?
China has industrial profits. Japan gives us the jobless rate, Tokyo CPI, and industrial production. In Europe, ECB President Lagarde is speaking. Plus, we get confidence indicators.
And the U.S., even with the holiday.
Still plenty. FOMC minutes from the Fed's last meeting are key. Personal income and spending data, and crucially, the PCE deflator, the Fed's preferred inflation gauge. The core measure will be watched closely, partly for any signs of tariff impacts filtering through. Plus, the usual manufacturing and confidence surveys.
Wow, that is a lot to keep track of. It really shows how all these pieces fit together, doesn't it? How every data point feeds into that bigger picture central banks are grappling with.
Absolutely. Each release helps shape the narrative, challenges or confirms the outlook, and ultimately influences those big policy decisions down the track.
All right, well, we've covered a huge amount of ground in this deep dive. We've looked at the RBA's rate cut and that interesting confident tone, their changing views on inflation drivers, the whole complex NIRU discussion.
And the NZ budget, the upcoming RBNZ decision there, balancing those near-term inflation pressures with medium-term risks.
And tying it all together with those global uncertainties, trade, inflation elsewhere, policy responses.
Yeah, I think if there's one overarching theme from this week's report, it's really that inherent uncertainty facing policymakers everywhere. Their decisions, their forecasts, they rely so much on estimating these really complex things. Trade impacts, labor market slack, household behavior.
Which kind of leaves us with a final thought for you, the listener, to maybe chew on. Given how much central bank actions and economic forecasts depend on these estimates, things like the NIRU or the neutral interest rate, concepts that, as we heard, even the central bankers admit they might have wrong, how much faith should we really put in these models?
The fundamental question, isn't it?
It is. And what does that underlying uncertainty mean for the economy's actual path, for future policy, and maybe for how you think about your own plans?
Definitely something to ponder beyond the headlines.
Indeed. Well, thanks for joining us for this deep dive into the latest economic thinking from Australia, New Zealand, and around the world.